Good afternoon, and thank you for joining us for today's Presidential Election Impact webinar. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I'm pleased to be moderating today's discussion. The 2020 election has proven to be one of the most contentious in recent history. Pair this with the fact that 2020 has been anything but ordinary, and you have an election year truly like no other. In light of this, our advisors have been engaged with clients in conversations around how the election results could impact their investments, taxes, and personal financial pictures. In hosting this webinar, we hope to share some of our insights with you, as well as provide a forum for your questions. Please use the Q&A function on Zoom to submit your questions. You may also submit questions by emailing me at dobrien@simonquickadvisors.com. I'd also like to mention that this call is being recorded and will be posted to our website and circulated over email tomorrow. And now, a brief disclaimer. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Now, let's introduce our panelists. Today we have with us our Chief Investment Officer and Managing Partner, Chris Moore, our Head of Investment Research, Wayne Yee, and our Head of Financial Planning, Bill Layler. Chris, I'd like to start with you. How has this election season been treating you?
Thanks, Darcy. With 3 little kids, Halloween is a really big event in my house. Fortunately, we live in a town where decorating lawns and front porches is also a pretty big deal around Halloween time. In fact, families can get pretty competitive with one another for trying to figure out who's got the scariest Halloween home with the craziest animatronic werewolves, witches, and skeletons. On my way to the office this morning, I came across one particular home that I thought was pretty noteworthy. It had a lawn sign that in large font said, 2020. It's the scariest thing that I can think of. Yes, 2020 has certainly been a year to remember. If a global pandemic, a global recession, and market crash in late March wasn't enough to scare you, we are also in the midst of a very politically charged election year in the United States. And believe it or not, Election Day is just 2 weeks away. Clients and investors are wondering, what should they do to prepare for the upcoming election? And results, what happens after the election? We appreciate that the uncertainty surrounding an election year can make investors nervous about what certain outcomes might mean for their investment portfolio or for their financial plan. A change in president and or change in control of the Senate could impact some sectors or industries more than others, but it could also impact tax policy, estate plans, and the like. So we've organized today's call to update clients and our listeners on our thinking and provide some guidance on what, if anything, should be done between now and the end of the year. We're here to help you develop a plan, both for your investments and your finances, that will help you feel prepared regardless of the election outcome. So I'm going to turn it over now to Wayne to give you a little market-related commentary.
Thanks, Chris. So pardon the ambulance that's going past behind me, but I'll provide a quick refresher on where we've come from and currently stand on asset allocation. So looking back earlier this year, as the market really started getting more volatile late February, we did move our equity underweight allocation to an equities target weight. We didn't anticipate COVID would have the impact that it did, but we always take a long-term lens with equities. And the spike in volatility that we saw in that latter part of February gave us an entry point to increase our exposure. Obviously, the world got much more volatile thereafter, but we maintained our equity positioning into that sell-off. We did make some pivots in the sense that we became much heavier in domestic large cap exposures, and we barbelled that with a quality defensive allocation on one side and companies that would be able to persist regardless of what the economic cycle is, and on the other side, long-term growth and tech-enabled businesses to drive the forward-looking kind of growth opportunity when the broader economy is slower. We also brought credit risk across the board. In credit, we bought across the rating spectrum. This was particularly in the back of the illiquidity squeeze in the March collapse. This was in investment-grade bonds, in preferreds, and in structured credit. And we have continued to retain an overweight allocation to alternatives. That includes private equity for long-term, high-quality growth, and hedge funds for diversification from traditional asset classes. Within that hedge fund bucket, it is a mix of high volatility return drivers such as biotech and lower risk, high quality returns like closed-end fund arbitrage. What we like about that bucket or that hedge fund allocation is that it does provide a wider pool of investable ideas and also creates a return stream that's differentiated from the S&P. So that's kind of where we were. Where are we today? Our view in alternatives, meaning hedge funds and private equity, continues to remain unchanged. We're still highly convicted and overweight those two asset classes. I would say our headline target weight recommendation in equities is unchanged, but that's at the very high level. When we look more at the underlying exposures within that bucket, we continue to have, we have been continually adding to technology and healthcare. We maintain our U.S. overweight, but we have shifted some of that capital into international equities, both developed and emerging. And we're utilizing small and mid-cap exposures for the potential benefit of a cyclical recovery. And we're doing that instead of looking towards value industries, whether it's in financials or value industrial, because we just think there's a little bit more support in that small mid-cap space as the economy does strengthen. I would say, while we aren't going to make a call on who wins the presidency, if there is heightened volatility in uncertainty or a certain outcome and markets do correct or sell off, we would view that as an opportunity to be allocating more capital into equities. We do think the backdrop of QE, fiscal stimulus, continued reopening of the economies to all be fundamentally positive to support the equity story. We see minimal absolute value in fixed income outside of structured credit. And with the heightened risk in around the increase in taxes, we are spending more time as a research team around tax-efficient income instruments, whether that's in municipals and real estate. And we'd be happy to talk about that as another point. So that's kind of where we are from an asset allocation perspective. I'll just touch briefly in terms of kind of maybe sector impacts of a, let's call it a Democratic administration or a Biden kind of presidential victory. So based on the polls, it looks like Biden is in a double-digit lead over Trump, but we saw what 2016 looked like, where the polls showed Clinton in a heavy lead, but at the end of the day, Trump did win. So we're not going to be aggressive and make a presidential call here. But what I do want to make a comment that what we don't see enough press around, or I haven't seen enough writing about, is what might happen in the Senate. Right now, the Senate is leaning Republican. The Republicans do have a majority. It's a hotly contested election period for the Senate, where if you look at kind of the odds or kind of different surveys, it looks like it'll break Democratic, which in itself is a kind of notable thing. But it's going to be decided by maybe a handful of seats. So it might only take a few seats for the Democrats to win the Senate. But if the Republicans are able to hold out and retain their majority by it only takes a couple of seats, that can actually change the overall outcome of this political cycle. And what I mean by that is, if the Republicans were to stay in power, whether it's Biden, if Biden comes in, it almost mutes his effect. If Trump retains the presidency, then then it's more of a status quo situation. So we do think it is important to think about how the Senate will actually shake out. And I do think it'll be less contested than the presidential election may be. So we'll have some good visibility around what Congress looks like on the Wednesday after the election. We do think that in the short term, a Democratic sweep would pressure markets on a short-term basis because the Democratic platform does talk about tax hikes for corporations as well as individuals. I do want to emphasize these are short-term effects because over the long term, it does seem like Democratic governments have been benign, if not beneficial to the economy and markets over multiple years. So the focus of this conversation tends to be more on the kind of on the really short term. Are there any notable impacts that we might see? So I'm going a little bit long here, but just really quickly in terms of what we're seeing, what we're expecting from a potential Biden win, because that would be the difference. A Biden win with a Democratic Senate. Obviously, we'll see a rollback of Trump's 2017 tax plan. So we'll likely see a rise in capital gains rates, as well as taxes on corporations. Companies with offshore businesses and assets, you'll see them likely get taxed more as well. Obviously, this will be a big impact or notable impact for technology and healthcare businesses and healthcare companies, and will be a benefit to less profitable or cyclical companies. Because of this concern, there is the market view that you will see a rotation of capital away from tech and momentum and into more stocks in the value and cyclical spectrum. We do recognize this is a risk, but it is short term because even with tax hikes, those tax hikes are used to fund fiscal stimulus, and fiscal stimulus will benefit the broader economy domestically otherwise, and that will flow through growth companies as well. So overall, it does kind of lift all boats in that situation, even though there are elements of those kind of short-term tax risks. We do think that there is heightened risk around the mega caps, just from a regulatory perspective. In our kind of global equities portfolio and our kind of recommendation, we are slightly underweight the mega caps and the FANGs, and we are leaning more towards growth in the next tier up and comers. They're still large cap companies. They're just not in the regulatory kind of scope or focus of the government. You saw those headlines come across on Google this morning. So we're trying to avoid elements of that. Finally, healthcare will also be a big focus. Under Biden, you will see a continuation of the Affordable Care Act. That will likely weigh on pharmaceutical companies and kind of profitability on those businesses. But overall, healthcare is a pretty cheap index or cheap sector in the index. So we do find a lot of relative value opportunities in that sector and have been pretty constructive on healthcare as a theme from a fundamental perspective and from a valuation perspective. We remain underweight financials and energy because they are cyclical, but frankly, under a Democratic administration, you might see additional regulatory pressure around there, whether it's on the banks or on or energy companies and drilling. So that's an area we continue to shy away from. And finally, the final comment on equities is that despite given the heightened volatility and the sharp rally in stocks and the election risk, we're more in favor of active investing in equities as opposed to passive. We do think that there is resilience in some of the actively selected stocks than just buying the biggest cap names across different sectors. So we think in this environment, active investing makes a lot more sense. And our portfolios are positioned to perform well in the medium term, and we think they should be pretty defensible in a short-term period, regardless of the election outcome. At the end of the day, there will be likely tweaks and opportunities on the back of the election, but we are looking to invest kind of through the election and at businesses and strategies that should be able to outperform over the longer term.
All right. Thank you, Wayne and Chris, for those opening remarks. We are getting a number of questions into the Q&A. So I'm going to dive in and address each of the questions in the order in which they've been received. The first question is from Kurt. Would we expect any portfolio rotations or shifts in allocations based on the results of the election?
Yeah, so our current allocation is meant to be pretty resilient regardless of the outcome, and we just kind of touched a little bit on that. We do think in a period of volatility, we will want to be buyers and be able to actively engage in kind of our existing exposures across growth and defenses. I think small caps and mid caps can be interesting in the sense that if you do have a stimulative economy, that should be positive to these smaller companies that should be able to grow next. I want to emphasize, like, if you look at the value index, there's a lot of financials and industrials in there, but cyclical kind of spans all sectors. So what we really want to do is kind of start adding that cyclical opportunity, but that is more via small and mid caps rather than large. And in the fixed income side, rates are really low. So what we're looking for is income generative opportunities that are more tax efficient or more tax aware that can still generate a better return than you would via investment grade corporate. So so that's kind of the area that we've been spending the most time on.
Thank you, Wayne. Our next question comes from Grant. While there is a lot of focus on a Trump versus Biden win, I think which party controls the Senate is likely to exert the greater impact on economic and financial policies. If Biden wins the White House and the Democrats take control of the Senate, then we will see changes in monetary and fiscal policy. But if the GOP retains control of the Senate, I don't think there's going to be much happen except gridlock. What's your take?
I can take this one. Wayne commented on this a little bit in his earlier remarks, but we would agree that if the Republicans maintain the Senate, it would be much harder, and Biden wins the presidency. It would certainly be harder for Biden and the Democrats to push through a lot of the policies that they've currently got on the docket. If the Democrats were to take the Senate and the presidency, it would likely be much easier for them to get through a number of initiatives. And what we're focusing on the most as it relates to that is the tax component, right? Both the rollback of the corporate tax rates, but also the potential increase in capital gains rates and personal income tax rates. And why that matters, quite frankly, is if the Republicans maintain the Senate, we likely think it'll be harder for the tax policy to change immediately, and it could potentially be longer before we see like real major changes to tax policy. And the rationale behind that is just we are in the midst of a global pandemic and a global recession. Certainly significant tax changes could meaningfully impact the economy and capital markets, certainly, but also the ability of corporations to have funds available for reinvesting in acquisitions or new hires or expanding their current footprint. So we're most focused on what the likelihood of a potential tax rollback happening quickly might be in the scenario where Biden wins the presidency and the Democrats take the Senate.
All right, thank you very much, Chris. Our next question comes in from Jim, and this is for Bill. Ideas for protecting assets if Biden wins, e.g. marital trusts to use lifetime exemptions, good or bad?
Thanks, Jim. The most important planning part of planning for a Biden administration is to start planning now. And I encourage everybody to meet with their trust and estate attorneys right now and review their estate plan. Because things are going to get very busy at the end of the year, and I wouldn't wait for election results whenever we receive them to start planning. And I do agree, if the exemption amounts are set to, right now they're 23.16 million for a couple. They're set to sunset in 2025 to 5 million. However, Biden has said that he would like to, make that happen a lot sooner and possibly even lower down to 3.5 million. So if your asset base is to the point where, and you're looking to get assets out of the state, now is the time to act. Marital trusts and spousal lifetime access trusts are great tools. They allow people to get assets out of their state now, use up their exemption amount, and still retain some access, down the road if needed. And that helps. We've seen that help clients get a little more comfortable with moving large amounts of assets out of their state, which can be a challenge sometimes to overcome. I also encourage everybody to look at estate planning opportunities that take advantage of the low interest rate environment we're in. We've seen a lot of clients use tools such as sales to intentionally defective grantor trusts, intrafamily loans to take advantage of really low interest rates. And for clients that have used up their exemption amount and looking to get more assets out of the estate, GRATs are always, grantor retained annuity trusts are always a great strategy as well, because they can be set up to not use up any more exemption amount. And at time of volatility, if you put assets in there that are going to rebound, you can still get some more assets out of your estate. So I think you're going down the right road. Marital trusts, spousal lifetime access trusts, where you can still access those assets are a great way to go. They can be structured in a lot of different ways depending on the states you're located, and protect your assets long term and be set up to be multi-generational as well.
Great, thank you so much, Bill. Our next question has come in from Jim, and he writes, if there is a blue wave sweep on 11/3, do you anticipate a rush to take capital gains by the end of the year to beat likely higher taxes in 2021?
I can take that one, and certainly Bill can jump in if he wants. From my understanding, the cap gains rate will increase on high earners only. Those with earnings above $1 million, quite frankly. So we would not expect kind of a significant market moving adjustment because folks are taking cap gains this year as opposed to next year. But certainly if, a high net worth individual who's considering maybe selling some of their concentrated stock or another private investment that they've owned for a long time, if they're considering selling it in the next year or even the next year or two, it could make sense for them to sell now as opposed to waiting. If we just assess kind of the viability of the investment and whether it's something you want to own over the long term or even intermediate term, it's more likely that you should just hold on to the investment, because any appreciation over an extended period of time could more than offset the tax savings you would have by selling this year versus next year. So we would be surprised if kind of there was a wave of folks realizing gains if Biden and the Democrats were to take the Senate towards the end of the year. We do think some investors may have already done that, since a lot of the polls have been pricing in a Biden, or a lot of the polls have been indicating a Biden win, and the markets are likely in some degree pricing that in already. So it wouldn't surprise me if we've seen some of the volatility kind of over the last 6 weeks being a factor of maybe folks selling in advance of potentially rates moving higher.
And I would add to that, Krista, just to agree with you, the stock markets have been compounding in double digits for the last 10 years. And I think when investors take a step back, and they look at the gains embedded in many of these positions, and then think about the 23.8% long-term gain rate plus maybe a state tax rate on top, it's still pretty significant tax liability. And I think a lot of investors, when they look at that, are going to hold off and choose not to sell. That's what I got.
Great. Thank you, Chris and Bill. Our next question comes in from Brian. How do you see interest rate changing regardless of who wins?
Yeah. If we think about interest rate policy, obviously Powell and the Fed, Chairman Powell and the Fed came out saying that they're going to keep rates low for longer, kind of at zero for longer until the economy gains enough strength and support here. So what that means is that we expect inflation to run a little bit hotter than historically. We're not going to say it's overly aggressive, but we do think that inflation will run a little bit hotter so that the economy can kind of regain its bearings and continue to kind of grow before we see rates increase. So we think interest rate policy will be very low. Now, the rising inflation will cause interest rate sensitive instruments to soften. And we saw some of that over the past maybe few weeks where the long end of the curve kind of longer maturity bonds started weakening or selling off because you are seeing inflation pick up a little bit and kind of getting paid 0 when inflation's at 2, you're actually losing money on a real rate basis. So from interest rate sensitive instruments will potentially weaken from that in that regard. And because of that, we have, to the earlier comments, we are underweight fixed income because on an absolute basis, you're not getting paid to own it. And then from a risk perspective, just owning treasuries, while you might not lose your money, you're not making any money on it. And the deterioration from inflation is another risk. So we have been shying away from being outright long risk assets. Now, we do have a fixed income manager that that has been performing very well in the midst of this market. And what they've actually been doing is that they've been putting on credit risk and interest rate risk, because credit and interest rate risk tend to move in opposite directions based on the economy. So that's an interesting way of playing the potential inflation or credit story. But kind of happy to talk about that kind of offline. But we do think that there is the room and risk for increasing inflation. Thus, we're underweighting fixed income. That's why I made a comment earlier that we've pivoted a little bit of capital more internationally and away from domestics, because if you do see increased fiscal stimulus with kind of aggressive monetary policy, it will be somewhat inflationary. So we're trying to diversify away from some of that risk right now.
Great, thank you, Wayne. Our next question in the queue is from Pam, and she writes, how could the potential delay in results from mail-in ballots impact the market's reaction, if at all? Will speculation cause things to be more volatile?
Yeah. I guess I'll think about that. Delays in ballots, contested elections. I think a lot of that will create the short-term volatility, and that probably creates more volatility than the actual outcome. The market doesn't like uncertainty because it's hard to plan around it. So when we wake up on Wednesday morning, we may not, it could be a contested election. And when else have we seen this? I mean, this was kind of back kind of in 2000, kind of the Gore-Bush presidential run, and kind of counting all the votes in Florida, the hanging Chad kind of saga. So that does create volatility, that does create risk. In that period, I think we saw roughly a 5 to 8 point sell-off in markets in November. And partly, the question is, was that because of uncertainty, or was it because we were kind of in the dot-com bubble and kind of nearing the end of or entering a potential recessionary period? So there's a lot of other factors that kind of played into that. But there will be, a contested election will create some level of uncertainty. And I think because of that, my earlier comment about where the Senate might shake out, that might create a little bit more more support. Where if the Republicans were able to retain the Senate, it kind of mitigates a lot of that potential risk. But we do want to say that those factors tend to be volatility and shorter term in nature. That in itself would not be a reason to panic or sell, and would use kind of panic selling as an opportunity for us to be allocating more.
Great, thank you so much, Wayne. Now going to move on to a question that comes in from Frank. How is the investment committee's view of markets influenced by the global rise of COVID infections heading into the winter?
I can take this one. Yeah, look, we don't see an all clear signal yet, for sure. We think economies and businesses are definitely adapting, and we continue to lean into the strategies that are really looking to grow over a long period of time. We're not trying to catch any near-term bounce. We remain cautious, as Wayne pointed out, on a number of industries that we think over the long term will be impacted by behavioral changes. That includes, and this is behavioral changes, whether we have a potential second wave or not. We've stayed away from airlines, from hotels, from cruise lines. We just think that a lot of kind of industries and companies have learned to work in a very different way. And in addition to that, are avoiding some things that they think are most likely to put them at risk. That being said, we don't think a second wave in the winter, this coming winter, would create as large of a shutdown scenario as it did earlier this year. It's likely that if we have a second wave, and that includes more people getting infected, greater hospitalizations, death rates increasing, it'll likely be regionally kind of controlled. So the shutdowns will happen, whether it's in a city or a state or a region of a state. It'll be very kind of limited to that specific area where the spikes are taking place. We've certainly seen here kind of in the fall as schools reopen, some not at all, some on a hybrid basis, and folks starting to go back to work, restaurants having limited capacity. We're certainly seeing some increase in cases, but if that continues, and certainly if it's certain regions that are impacted on a greater basis, a lot of those reopenings will probably be closed down again, right? Where the schools will potentially shut, the restaurants will potentially shut. Whether people aren't maybe allowed back in office buildings will certainly depend on what's specifically happening in that area. But we're not of the view that we will see anything like we did in kind of the second quarter of this year. And the reason we're saying that is we think that people understand more about the virus today, certainly a lot more. There's certainly optimism around a potential vaccine, whether it's early next year or later next year, and how available it's going to be for the greater public. But people will change their behaviors even more so if they start to see cases spike in their particular area. And that will likely prevent kind of a broad-based national crisis like we saw in the second quarter. The other thing that is certainly worth mentioning is healthcare facilities are definitely going to be better prepared this time around. Access to PPE is going to be greater this time around. So I think as a country, even globally, we're just more prepared for any potential second wave, which would certainly help from a market or economic impact perspective. And then the other thing, and lastly, is we've seen enormous stimulus in the U.S., especially as it relates to low interest rates, quantitative easing, Fed balance sheets expanded by over $3 trillion. And then certainly the CARES Act and potentially more stimulus will likely continue to support the economy. But I don't envision a scenario where we would have as broad of an economic shutdown as we saw in the second quarter. So, we're definitely talking about it on a regular basis at our investment committee. We're definitely kind of discussing potential scenarios and what that could mean. But we're kind of in the camp that any second wave is not going to have nearly the level of impact it did the first time around.
Great, thank you so much, Chris. Our next question is from Jennifer. What are the potential tax implications from a Biden presidency and Democratic House, and what investment strategies would be utilized in this type of tax regime?
I'll touch on that. I guess the leading comments are that under a Democratic administration, we should expect to see higher taxes, whether that's on the individual or at the corporate level. The question becomes, is that next year or the year after? It's probably more of a question of when, not if. And I think there's some certainty around the level at which that we might see some of those increases. But it will be less. It will be a higher tax kind of regime that we will be in. Having said that, kind of how do you invest based on that? We don't want to make kind of investment calls based on that tax plan in itself, because you're taking taxes, and it's not just like, hey, give us your tax, kind of pay us more taxes, and then we just use it to keep in the coffers. The plan would be that if you raise tax revenue, you use that to re-stimulate the economy. So there are other avenues and opportunities for growth in the broader kind of market to kind of benefit from that, and that's really where the small and mid cap kind of bet would come in, or recommendation would come in. But I do think if you think you're going to need liquidity, and that's one element where you know what the tax environment is better now than it will be in the next 1 or 2 years. So if you think you will need liquidity, then might as well kind of take advantage of that today. But that is really a cash planning role, not an investment kind of decision. So we continue to use equities, whether it's in the private space or in the public space, to be a long-term return driver. And that will look through the next 4 years. That will look through the next 4 years thereafter. Will Biden be a transitional government, and kind of someone else coming back after one term? Will someone else come in and rather than Biden trying to run again? So I think there's lots of kind of unknowns beyond just November. So we just continue to have the longer term view around equities. Now, on the income generating side, once again, we made comments around being more tax efficient around kind of income generation. There's kind of ways to be more thoughtful around kind of income generation or kind of return of capital, which gets characterized not as outright income, whether that's in real estate or in municipal, high yield municipal. So that's really the area that we're looking at to kind of complement the capital gain story within equity. Dividend stocks, that's another area too, that would be a way of getting some income back versus just outright ordinary.
Thank you, Wayne. The next question comes in from Brian. Will we see Fed action for taking nominal interest rates below zero?
I'll take that one. I would be really surprised if we saw nominal interest rates below zero. I think the Fed has been pretty transparent in communicating that they have no interest in getting nominal interest rates below zero. Certainly, we've seen below zero rates in other countries, and the market could definitely drive rates very low, but I don't think it will be Fed driven. It's more likely that we'll see more QE or more stimulus from the Treasury and other kind of creative ways to support the economy, whether it's through small business or the consumer, versus a rate move. I think the Fed was pretty aggressive in March, cutting rates and sending a signal to credit markets that ultimately affected equity markets too, that they were serious about making monetary policy as favorable to markets as possible, so that we could kind of get through the pandemic.
Thank you, Chris. Our next question comes in from Tracy. In the case of a Democratic sweep or blue wave, are there any investment strategies that can take advantage of a potentially heightened focus on environmentally sustainability?
Yeah, I'll comment a little bit on that. In a Biden administration, that will be a negative for energy producers, I'll say kind of drillers specifically. And there will be a heightened push for renewables. And how do we take advantage of it? We actually have a fund that focuses highly on renewable and alternative energy sources. It's kind of an interesting fund. We actually wrote about it in maybe one or two, probably maybe 2-3 kind of newsletters ago. But they're lending to new growth businesses that are kind of targeting electronification, kind of recycling waste materials, kind of more efficient sourcing of water purification, and what have you. So I do think that avenue will continue to draw attraction and interest, partly because it is a growing opportunity, regardless of the administration. You see the energy and the gasoline companies also kind of dedicating a lot of capital to renewables as a future growth opportunity. So under a Biden administration, that will likely continue. But yeah, on the platform at Simon Quick, we do have a fund that has been kind of focusing specifically on the renewables and sustainable opportunity set.
Thank you, Wayne. Our next question comes from Lester. If capital gains rates go up with a Biden administration, are opportunity zone investments still attractive given rates at 20% versus potentially 40% in 2026 when the taxes are due?
Yeah, opportunity zones. I guess I'll touch on this as well. So let's say taxes go up or taxes are higher at the point where you have to make payment on your deferred taxes. Yeah, unfortunately, in that period, you will have to pay higher taxes. But it does become a little bit of a seesaw effect where if you're paying more taxes because of a higher kind of tax regime in let's call it 2026 for 2026 payments, your 10-year hold opportunity becomes that much more attractive because the readjustment of the basis becomes that much more beneficial to that 10-year holding period on OZs. So yeah, maybe you pay a little bit more in the near term, but you make a lot more in the long term. So it doesn't wipe out the opportunity. It just kind of adjusts the way you get paid out. So at the end of the day, though, we still think it's highly tax efficient, and if you have gains, it is better to take advantage of the structure of opportunity zones to getting long-term tax efficient capital gains.
Thanks, Wayne. Our next question is from Racine. I'm a business owner with approximately 15 million net worth, most of it tied up in my business. What planning actions should I be focused on before the end of the year?
Sure, I'll take this. Thanks, Racine. Right now, your focus really should be on getting assets out of your estate. It's really important to get started right away and to review or draft an estate plan with your attorney. They take time to create and implement. So I would not wait for the election results to start. There's a lot of techniques using LLCs and different type of trusts where it's possible to transfer business interest out of your estate while maintaining control. And there may even be discounts for lack of marketability or minority interest that you could take as well. The goal is to freeze the asset for estate tax, allowing all the future appreciation to happen outside of your estate. At 15 million, you're already above the amount. Should it sunset, which they've talked about, I mentioned earlier, going back to 5 million in 2025, and a Biden administration is looking to do this a lot sooner and possibly even below the 5 million amount. So I think the time is now to really get some of that business interest out of your estate, if that is your long-term plan. The goal of this is, your business may be worth 15 million right now, but in years it could grow to well beyond that. Also, at the time of a sale, it could be much higher. So the goal is with the freeze, once the asset's out of your estate today, all that future growth is no longer in the estate. The Biden administration has also proposed doing away with the step up in basis at death, which means that beneficiaries would inherit assets with built-in gains, as compared to in the past where they would receive assets that have stepped up to fair market value, so no gains. There's still a lot of gray area around that proposal. They haven't even really made it clear yet on whether those gains would be able to be deferred to a future sale date. So there's a little uncertainty around that. But all this just leads to the benefits of focusing on getting the assets, taking advantage of the exemption amount and getting the assets out of your state now.
Great, thank you so much, Bill. Our next question comes in from Jeff. What do you think the long-term effect of the stimulus money used to help Americans on the national debt will be?
I can take that, and I'm sure Wayne will have something to add too. Certainly, the national debt situation after the pandemic has only worsened. Right, we've been highly stimulative this year, and the good news though is that rates have come down, so the cost of that debt is kind of, depending on the math, either about the same or a little bit lower the last time I looked. Then again, because we're certainly buying more assets every month, that may not be the case anymore. To address the national debt is certainly to generate more revenue through tax code, which Vice President Biden has already proposed. We'll likely see higher taxes either with a new administration, or if Trump is reelected, the next administration in 4 years. One of the things we talked about at a prior market call in the second quarter was kind of what the Fed plans on doing this time around relative to kind of post 08 and the global financial crisis. We're hopeful that the Fed starts to unwind QE faster this time around than they did post 08. And we're hopeful that, once we start to see the economy recover and, get back on stable footing, the Fed potentially starts not just stopping the purchases of assets, but start selling them back into the market or just letting them term out. And then secondly, the hope is that rates will also move higher faster this time around than they did post 08, because we were certainly in a extended low rate environment for quite some time, and we need rates to move higher to prepare us kind of for the next major event or recession, and allow us some kind of wiggle room to ease and support the economy. Wayne, anything you would add?
Nothing new to add, and I think this is almost the same thing that we were talking about back in let's call it the 09 or 9-10 period, where QE was used to really try to get us out of the GFC. And at that point, we're looking at a lot of kind of international companies in addition to, or international countries, foreign countries, as well as the US, in terms of increasing deficit, increasing debt balances. We kicked the can down and had done well over the past decade thereafter. This is a continuation of that. I do think it'll be choppy when the point where we finally do start raising rates. It will not be linear, and it'll be pretty choppy in that period. But I think that's why we continue to look for long-term growers to be able to solve for the rising rates, the potential slowing in growth. Yes, I think that's kind of the way we're postured today for that.
Great, thank you so much. Our next question comes in from Lance. What does an increase in commercial mortgage defaults mean for the commercial mortgage-backed securities markets?
Yeah, I can touch a little bit on that. You would think that with everyone working from home, with brick and mortar not having foot traffic, with hotels not having any occupancy or not even wanting to be open because of the overhead, that you'd see a lot more, a larger default wave in real estate. Frankly, it's been lighter than expected, and fundamentals overall have been much better than expected. Collections have been still in the mid to high 90s. Occupancy continues to remain really strong. Now, some of this is artificial, and some tenants just haven't decided when to kind of roll out of their expiring leases, and unemployment kind of benefits have kept people in apartments as well as kind of kind of government programs to stave off kind of pushing people out. But I would say across commercial mortgage broadly, the most invested part of the market tends to be on the higher credit quality, the investment grade tranches, where that part of the market really hasn't seen any kind of fundamental impact. The major impact has been on the more single asset or kind of tightly held asset or kind of hotel and retail oriented CMBS loans and CRE loans. And that is creating some default pressure. There is, I'd say, greater alignment of the equity and the lender at this time because no one technically did anything wrong. Leverage wasn't kind of above, wasn't excessive. The COVID effect really just kind of impacted the economy all at once across the board. So I would say there's been a more consistent kind of reworking of debt maturities and kind of being extend maturities, defer payments, because the sponsors are doing the same with their underlying tenants, kind of holding off rent payments, allowing for them to stay longer in the space. But the trade-off is we're going to extend your maturity, or you have to sign up for an extension on your lease so that I'm not dealing with a maturing tenant a year from now or what have you. So I would say because of those elements, the impact to real estate hasn't been as dramatic. Transaction volume overall has been really low. So I think even price discovery has been a bit of a question around here as well. But I think there will be an opportunity in real estate. We're spending a lot of time on it. There's some tax beneficial elements around it as well. So really, I think we'll have some more to talk about that in the coming months. But default cycle hasn't been as bad as expected. It's been managed overall. So the opportunity really hasn't availed itself. But we do think it may be coming, but in a more episodic, hotel-oriented, mall repositioning, kind of the same story that we've heard even prior to the recession that will create the most amount of opportunity.
Thank you, Wayne. Our next question comes in from Al. What is the history of contested elections in the United States and their effect on markets?
Yeah, we touched on this a little bit earlier, but whether it's a contested election, whether it's questions around contested elections, I guess with the whole mail-in ballot element that's going to get caught in that. The 2000 election period was the one that we spent some time around. And then the one prior to that, I think, was like in the 1800s. So I don't think it's as relevant, but it'll create volatility. But in that period of volatility, we do think it may create opportunity where uncertainty will kind of maybe make things a little bit more attractive to buy. The interesting thing about the election versus kind of COVID was, I would say for COVID, it was more unknowns. The unknown unknowns, like what is COVID? How does it impact you? Is there a potential drug kind of solution? What will economic or business shutdowns actually look like? These are all kind of new, and we as a country, we're kind of going through it together and trying to figure it out as we go. With the election, it's more of a known unknown. Like we know where the questions and the risks are. So I think there's a better handle in terms of what the potential outcomes, and you could do the Monte Carlo across different lines. So I think because of that, the risk will be much more controlled than what we had just experienced. Now, I'm not saying it doesn't mean there still will be some volatility and you could see some market pressure, but I think that the impact of it will be lighter than what the market may be expecting or anticipating.
Thank you, Wayne. We have a few more minutes. So if you have not yet submitted a question that you would like to ask, please go ahead and drop it into the Q&A. Our next question comes in from Maria. What are some ways to lower income going forward?
Sure, I'll take this. Thanks, Maria. Controlling your income going forward is going to be more important. I mean, it's always important, but when we're facing higher rates, it should be even more in focus. The Biden administration wants to, restore the 39.6 top income tax rate for incomes above 400,000. We've already talked about how, the capital gains rate for income taxpayers with incomes above $1 million may go up to 39.6. And then they're also talking about limiting itemized deductions to 28%. So a focus on income right now is more important than ever. Things you can be doing to offset income this year and going forward. One strategy I like is Roth conversions. A Roth conversion is taking an IRA and converting it to a Roth IRA. Roth IRAs have a lot of benefits. All the distributions are tax-free. There's no required minimum distributions. So you can really defer those assets long-term. When you convert a Roth IRA or an IRA to a Roth IRA, you do pull forward and have to pay tax on that income. So you can look to do it in years where maybe you have a low income tax years for a number of reasons, or losses from a business, or making a large charitable contribution where you can offset that. Another technique I like a lot going forward is qualified charitable contributions, also called Qcds. A QCD allows you to take up to $100,000 and contribute it directly to a charity, from a qualified charity from your IRA. And this covers your, it can recover part or all of your required minimum distribution. The great thing about this strategy is it's not like a typical charitable contribution where it's an itemized deduction. A QCD never even factors into your AGI, so it has a greater impact and lowers your overall income for the year. It can be a great technique you can use year after year. I still recommend always looking, when you do make traditional charitable contributions, using long-term appreciated assets where you get the deduction for the full fair market value, and you don't have to realize the gains of the position you donate. In a very high tax year, you can look to lump together multiple years of deductions using a donor advised fund. I think asset location is always important, but going forward might be even more important. Making sure we're putting least tax efficient investments inside tax advantage accounts such as IRAs, Roth IRAs, and maybe even cash balance plans. Also, just looking at the type of investments you were using. I think Wayne mentioned earlier, municipal bonds may become more attractive. Tax advantage strategies like we use Aperio, which is an equity manager that has an active strategy to realize losses and push them out. Going forward, for some investors, those losses may be a lot more attractive, worth a lot more at 39.6. And as always, we're making sure we're maxing out retirement accounts, health savings accounts, deferred compensation plans, anything you can do to defer income in the current year. Business owners, you want to make sure you have a profit sharing 401k plan set up, and maybe even a cash balance plan to really let you defer a lot of income. And I also think, insurance policies, investing inside insurance products such as private placement, life insurance, and private placement variable annuities, which are a great way to shelter income on assets, will become more popular. These strategies I mentioned, don't work for everyone, but if you work with your advisor, they can pick the ones and craft it into your financial plan that work for you. Darcy.
Thank you very much, Bill. Looks like we have one more question in the queue, so let me just take a look at that. Make sure I'm not missing something. All right, good. Well, sorry about that, guys. It looks like it was just a comment. So at this point, there are no remaining questions in the queue. And I'd like to thank everyone for taking some time out of their day to participate in today's webinar. Thank you, Chris.
Thanks, Darcy.
Thanks, Wayne.
Thank you.
And thank you, Bill.
Thank you.
As a reminder, we will be circulating the webinar recording over email tomorrow, and it will also be posted on our blog. If you have any additional questions that we were not able to address during the call, please do not hesitate to send them to me at dobrien@simonquickadvisors.com, and we would be happy to address them offline. Thanks again for joining us and have a great evening.